Right, so we have the 2013 ratios question here. Yeah, it's fairly straightforward again. You're seeing the same ratios in part A. So we've got Danzig here. Again, just the first thing I'm going to check, thinking about these going forward now, is the share price. So the share price is 90 cent last year and it's 85 this year. That probably suggests things are going to be negative in our report. Okay, next thing then, just looking at it, see here you've got interest and it doesn't tell us what the net profit is. This 31,000 is the net profit, so I would label that net profit. Then my 5% preference shares, obviously it's there 5,000. And then going down to see what they're asked, again we'll get to this. You've been given the opportunity to buy 200,000 shares. So remember, you have to put in the market value of shares in as one of your answers when we're asked this way. It's very similar to one from maybe 2016, was it? Where you have a choice of buying the shares at 80 cent each. So you're spending 160,000 on existing shares at a borrowing of rate of 8%. So it doesn't affect gearing or anything like that, but we need to look at it in the context of their ability to pay dividends and so on, or whether the profitability and dividend rate is going to be above 8%. Really, that's what we're looking at. So keep your focus on that 8% really as you go through the question, and anywhere where you can put it in, do put it in. Okay. So anyway, before we even get to that, we have to do our ratios. So it's our opening stock one at this stage. So if the stock turnover is 10, stock turnover is cost of sales over average stock. So that's equal to 10. So 10 times average stock is equal to 852. So cost of sale, our average stock is going to be 852 divided by 10. So then you've got your opening stock plus closing stock over 2 is 852. Now we know our closing stock is 31.5. So again, if you just take the difference between 31.5 and 85.2 and whatever answer you get added on to 85.2, that'll give you your opening stock. Because if one is below the average, the other has to be above the average by the same number. Now the other way, of course, is opening stock plus closing stock over 2, cross multiply, and you'll get opening stock plus closing stock is 85.2 by 2, so 170,400. And then we've got our closing stock, as we said, of 31.5. Opening stock plus 31.5 is 170,400. Take it away and you get 138,900. Part 2 then, earnings per share. We know it's net profit minus preference dividend over issued shares. So the net profit is 31,000. That might have thrown a few people that year because it didn't actually say net profit, but that's the net profit, the one after the interest. So 31 minus 5 over 550 is 0.00473. So that's 4.73 cent. Dividend yield then is dividend per share over market value of 1 share. You need to find the dividends per share to be useful later. So it's the total dividend, 25, minus the preference, 5, so that's 20,000 over the issued ordinary shares, 550. Again, it'll be 0.0364. So multiply that by 100, you get 3.64 percent. Jesus, dividend yield. That's dividend per share, sorry, cent. Dividend yield then, I don't know why, I didn't change that. Sorry, that should say 3.64 over 85. I took that number from the last question. So that should be obviously 3.64 divided by 85 multiplied by 100, which is 4.28. Now this one is how long it would take one ordinary share to recover its market value at present earnings. So earnings rate is EPS. So the last question was dividend payout rate because it had mentioned dividends. If it says earnings, it's the price earnings ratio, which is market value over EPS. So 85 over 4.73, which is 17.97. Okay, and then the interest cover, net profit plus interest over interest. So 31 plus 16 over 16 is 2.94. Okay, so nothing too difficult there. The report you're looking at this potential new shareholder, and it's of the existing shares. It's not of the remaining issued shares. If it was any of new shares, you know, the difference between your ordinary and your issued and your preference, your issued and your authorised will come into play, and at that point you would look at new gearing figures as well. But it's not relevant. We haven't seen it in a huge number of years. A couple of things to note: he's getting the shares for 80 cents, and the current share price 85%. The other thing to note is that he's borrowing at 8%, and we need to focus on this 8% as we do the question. So, usual process, followed through from profitability down to sector, and then remember what extra one do you have to put in depending on what you're being asked. So if it's loans, you put in your security and fixed assets. If it's shares, you put in the market value of the shares, and investments is always a good one to put in. Okay, now I'm advising him against borrowing the money because I've done this already, but also share price is falling. It's going to be a good sign to avoid, like the plague. Anyway, profitability, profitable company, they're always profitable companies. Return on capital employed of 5.37, which I worked out, and that's down from 6.1 the previous year, so it's a negative trend. Above the risk-free rate of return, which is good, but it's below the cost of borrowing, the debenture rate of 8%. So they're not making efficient use of the resources. So the company will be borrowing at a higher rate than their profitability. Okay, now in the marking schemes, I checked these afterwards, and I really should have adjusted mine. And we'll look at this in class after Easter. They put in the period to recoup. So the answer may be from. No, it's not. It's they put in the period to recoup the share price. Yeah, based on the 80 cent. So if I'll do it after Easter. But if you took the 80 cent, if you change this. Sorry, where are we at? Period to recoup. There it is. There. So if you change that 85 to 80, let's have a look at what you get. So you'd have 80 divided by 4.73, and you get 16.91, so it's not too bad. You might mention that within your profitability one. Okay, the other one you could put in will be on current dividend payout rate. Anyway, that's our profitability over. We'll look at that again, as I said. Dividends per share 3.64, down from 4.7, negative trend. Dividend yield 4.28, down from 5.22, negative trend. And again, your sentence about it being the interest earned from owning profits. The yield is below the cost of borrowing for the investor of 8%. So again, why would you invest? You're not going to. The yield is below the borrowing rate. Now, again, just like in the last one, we can work out what the interest on the loan is. So you're borrowing 160,000. So 80 cents by 200,000 is 160,000. That should probably be 14,000. So that's a typo. So 8% of 160,000 is 8,000 plus 480. It's 12,800. That should say. Now you're expecting to get a dividend of 6,480. So that's your dividends per share multiplied by the number of shares you're buying. So it's really a poor investment opportunity. If you're paying back more interest than you're actually you're getting in dividends, you're in a bit of trouble. Dividend cover 1.3 times. Now they didn't give us the dividend cover from the previous year, so we can't compare it. It's very low, and not enough of the profits being kept in the business to fund expansion. Usual line around dividend cover, and the overall return dividend cover by dividend yield is 5.56. You might want to check that. That could well be a typo. Below the cost of borrowing and not significantly higher than the risk-free rate of return. So that's another negative for us. Okay, so that's our dividends done. Our liquidity and even it's 0.75, so current assets minus closing stock, so 158 minus 31.5 is 1265, and compare that to 168, it's 75%, so it's 0.75 is to 1, and it's down from 85 cents is to 1, so that's a negative trend, so, and both are well below the ideal of 1 is to 1. So they have a liquidity problem. So they've only got 75 cents of liquid assets for every euro of short-term debt, and they'll have difficulty paying their short-term debts as they fall due. What will that mean for shareholders? For shareholders, I mean it reduces the likelihood of them getting a dividend. So they'll have difficulty making future interest payments, but they will also have difficulty making future dividends payments, which is what we're interested in, because they won't have the cash to do it. Okay, so referring to dividends as part of liquidity is important for investors. Gearing and interest cover. So gearing is low, unless I made a mistake, but it's 34.24 and it was 30%, so that's a negative trend. It's still low gearing, and it's fine to say the gearing is good. So it's slightly worsened, they're still lowly geared, and I just wanted to put in something negative so that they're slipping, but so that should say, it must be said, they are, comma, it must be said, comma, I don't know why I put in, it must be said, funded more through equity than long-term debt, and they're not dependent on outside borrowing. So it's important to put that in. Not everything has to be negative. The interest cover is down from 4 times to 2.94 times, so that's a negative trend. Define what that is, the number of times interest can be paid out of profits. They're fine at the moment. The company is in a good position to pay its interest presently, but the falling interest cover does concern, and if the trend continues, they may have difficulty paying their interest, especially if profits continue to fall and liquidity worsens. So you can put in either of those. Now the market value of shares is the big one for the market value of shares is the big one for this type to put in. So the share price is 95, it's down to 85. That's a 10 cent or 10.5% fall in share price. And falling share price indicates that the market do not have confidence. Now, you're getting a discount. You're not getting them for 85 cents, you're getting them for 80 cents. And that's good, but you can't ignore the fact that the share price is falling, and that fall from, the share price could fall below that 80 cent very, very quickly with their current standings. Now, she was due to buy 200,000 shares, so it's important to show you how much of the company she will own. 200,000 as a percentage of 550 is 34. So she would end up owning 34% of the company, making her a significant shareholder. That's you don't want to be a significant shareholder of a failing business unless you can turn it around. Price earnings goes in here, so it's 18, it's up from 16.4. Just come up with some negative, which it is, so it's going to take you longer, so it's not exactly an appealing investment. Okay, sector, so we checked at the start, and they were manufacturing in food processing, which is a pretty good sector actually, so you have to come up with a couple of negatives. So said in the short term, obviously Brexit and COVID are challenging. In the long term, it's a good industry to be in as long as you can face off the competition from abroad. So my two negatives were COVID and Brexit in the short term, my 3 negatives then really, and then serious competition from abroad. And my positive is if they can face off the competition from abroad, the long-term prospects are very good. And loads of other Irish businesses have shown that. Okay. Part C is a strange question. I'm going to, again, we check the marking scheme as well yourselves on this, because I answered this a very specific way. So it says Danzig is considering expanding. Well, they won't be able to expand, but that's not too relevant. The following information has been obtained, and it gives you the return on capital employed, the current ratio, and the asset test ratio. And it's asking you, can you say which of the businesses is better to invest in? Now, I have an opinion on which is business is better to invest in based on those, but my opinion doesn't match the marketing scheme. So um, I went with don't invest in either of them as a result. But basically, what I said, I compared each of the headings. So um, I looked at the return on capital employed first. So obviously AB is more profitable than XY, 8% versus 6%, but not everything is about profitability. So I looked at the current ratio then. 3.2 is very high. 1.9 is, it's below the ideal, but it's not too far below the ideal. I wouldn't worry too much about that. And then this is the one where the interesting things are. The acid test ratio for AB is 0.6 to 1. Now that indicates they have a serious liquidity problem because they have a current ratio of 3.2 to 1 and a acid test ratio of 0.6 to 1, which means that they have way too much stock. Remember, the difference between the current ratio and the acid test ratio is stock. So they're carrying far too much stock, and if you've got money tied up in stock, that's not a good place to be in. So I said there, it's a 0.6 to 1 below the ideal of 1 to 1. Couple that with the current ratio of 3.2 to 1. That tells us they've way too much stock. So they probably have half of their current assets in stock, or more than half their current assets in stock. XY, on the other hand, is 1.3 to 1, which is above the ideal of 1 to 1. They're relatively close to between their current ratio and acid test ratio, and that suggests a couple of things. It suggests they've probably got a good stock management system. It might say they could have some cash control issues, but there's nothing to say that for definite. You'd have to look into more detail on it. Now, if they asked me to make a definite decision as to which one I would invest in, based on those figures, I would invest in XY Traders. But they gave me the option to say which business, if any, would you purchase stuff in. I wouldn't buy into either business without further information. So that's what I gave as my option. In the marketing scheme, they went with AB Foods, I think. I would have gone for XY Foods, as I said. So that's why I said as my answer. And as long as you can justify it, it's not right or wrong, you'll be fine. Anyway, I hope that's of use to you. Again, just a couple of little typos in that. I will see you again.